Hi, today on the Apartment Dealer Show, we have our 2023 year-end multifamily update, as well as our 2024 outlook. What happened in the world of multifamily properties here in Southern California? We have all the data. Stay tuned. Hi, this is Kris German, and welcome back to the Apartment Dealer Show. Today we have for you our 2023 year-end multifamily market update, as well as our outlook for 2024. What happened in the world of multifamily real estate when it comes to overall sales volume, price per unit, cap rate, all the metrics? What are the highest sales that occurred in your area of ownership? And as we look at that data for 2023, well, what does that mean? What do we compare it to? So we're going to compare against 2022, which obviously 2022 for multifamily real estate here locally was a banner year, a historic year. And so we definitely see some stark differences, but we can see some opportunities developing, and it helps us develop our strategy as we begin to contemplate as investors and landlords, how am I going to make my portfolio, my money grow over the course of this new year? Happy New Year. So those of you watching, glad you could be with us. And I think that you're going to find this information very informative. If I wasn't in the business myself and just a landlord, this is the channel that I would turn to because of the analytics shared. It's real practical information that you can utilize to develop your strategy. Okay, so let's get into the particulars. Now, if you're familiar with any of our market update videos, you know that I speak to those areas that I service as a realtor, that my clients own in, or that I own in myself as an investor. I don't step outside my lane. So we won't cover, for example, Orange County. Although I've helped investors in Orange County, it's not our primary area of service. Neither is San Diego County or Santa Barbara. So yes, we're here in California, and yes, we're in Southern California, but we get much more granular than that. And we have a handful of corridors that we service, and they go like this. So I'm sure we have the map up here, but our first corridor is the East Los Angeles corridor, which consists of Boyle Heights, East LA, and El Sereno. Our second corridor is what we call or coin as the 710-91 corridor: Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, and Southgate. Then we have the Western San Gabriel Valley: Rosemead, San Gabriel, and Temple City. The Eastern San Gabriel Valley: Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. The 605 corridor: Bellflower, Downey, La Puente, Montebello, Norwalk, Pico Rivera, Paramount, Whittier. The Inland Empire West: Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, Upland. The Inland Empire East: Bloomington, Colton, Fontana, Rialto. So, Kris, why do you group the cities the way you do? Well, in general, the tenant base, rental rates, and market value of the various cities that we've put together are about the same. And so the data is from one city speaks to a landlord of another. And oftentimes, the investors, their holdings are intermixed within these individual cities. A lot of them like to have their properties in a certain nucleus, a certain geographic area, a certain radius, if you will. And this is what we find. Again, it's just helpful to break down the information in this way. Now, maybe you're only interested in one particular corridor. You don't want to have to watch the entire video. You're saying, Kris, give me the punchline for my area. No problem. If you notice along the bottom of this video, it's broken into various chapters. Jump to the corridor of interest, or those corridors you're interested in. And then I would say, once you've done that, head on over to the last chapter where we're going to kind of bring it all together in summation in terms of what have we learned about 2023, what can that tell us about 2024. Let's begin with the East Los Angeles corridor. Now, again, this is Boyle Heights, East LA, and El Sereno. In 2023, there was 18 sales. When compared to 2022, there was 20 sales. So not much of a difference there, about the same number of transactions. Now, sales volume. If you took a look at the total value of the buildings that sold over the course of last year, you'd come to $26,340,000. What was it in 2022? $27,630,500. So roughly about the same. Down, which we would expect, down slightly, but not to a great degree. But then the numbers pick up from there. Price per unit for 2023, the average price per unit that a property sold for was $196,000. When compared to 2022, that was $210,000. So that's about a 6.8% difference in price. In other words, prices went down over the course of 2023, close to 7%. Now, when we take a look at cap rate, and we'll put a link here in terms of our video on cap rate, how do you calculate cap rate? But over the course of 2023, the average cap rate for those properties that sold was 5.2%. The year prior, 4.6%. So definitely a change in direction in terms of property values. We see price per unit coming down. We see cap rates going up. Price per square foot, $298.51 over the course of 2023 compared to $328.46. So again, slightly down from where we were over a year ago. Now, how many buildings are there in East Los Angeles, in case you're curious? Now, we track sales of those properties that are between 5 to 50 units. So again, once you get above 50 units, that becomes another asset class, if you will, in terms of the investor base and what have you. And the 2 to 4 unit market skews things. That's its own market of its own. So our clients and the investors that we serve as realtors here at the Apartment Dealer typically own properties between 5 to 50 units. And so there's 690 properties in this particular corridor of that size. Just give you some idea, when I say there was 18 sales, it's 18 sales of available stock of 690. Let's highlight a few sales here over the course of 2023, the highest sales that we saw. Well, in El Sereno, there was a 5-unit property that sold for $334,000 on Alhambra Avenue. Now, that sale took place in May of last year, and that's telling because properties continued to decline in value over the course of last year. So typically, the earlier you sold something in 2023, because you were coming off the high of 2022, you see a higher price versus something later in the year. That one sold in May. This property in East LA 90022, 5 units, sold for $292,000. And that was March of last year. So again, earlier, the first quarter of last year. Now, rental rates. You can pause the video here, find the city of interest, just go straight across, find the bedroom count. And what you have there is information that we've pulled from 3 locations: Rentometer, Zillow, and CoStar. We bring that data together to give you the average asking rent per bedroom type. Now, are there units collecting less? Of course. Are there units collecting more? Of course. These are averages, but we share that with you. Now, if you own rentals in other areas or just curious, what are the asking rents in other geographic markets? You can go to raisemyrents.com. Again, that's raisemyrents.com. I'm sure we have the link here. And you can download our free report where my team gathers the current rental rates, asking rental rates for the various areas that we service. And that report is yours to have, and we're happy to share it. Now, the 710-91 corridor, Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Southgate. As we take a look at 2023, there was a total of 34 sales. How many in 2022? 58 sales. We're talking about 41% less sales last year when compared to 2022. Well, how about sales volume? Sales volume last year was $58,865,000. What was it in 2022? $134,704,000. So you're talking about a 56% decrease in the total sales volume of multifamily properties here in this corridor last year. Price per unit, the average price per unit for those properties that sold last year was $223,000. In 2022, it was $253,000. So on average, properties are selling 12% less than they were a year ago. Cap rate, the average cap rate here in this corridor for 2023 of 4.8% versus 2022 of 4.3%. So of course, as prices have come down, we've seen cap rates rise. And then your price per square foot, $328 last year, which interestingly enough is slightly higher than 2022. So there might have been a few kind of one-off sales that raised the price per square foot. Now, in this particular corridor, there's 2,460 67 buildings that are between 5 to 50 units. That's the size of property that my team and I track because our clients, our investors, typically own properties that are 5 to 50 units. And once you step above 50 units, that becomes another asset class of its own, a different buyer base. And 2 to 4 unit properties, that's its own market on its own. 5 to 50 units is our sweet spot. And so that's when I'm giving you these averages and this data, it's speaking to those properties that are of that size. Now let's take a look at some notable sales from 2023. Now, something to take into consideration is that the earlier in the year a property sold, typically it's going to have a higher price because it's coming off that high of 2022 versus if you sold a property later into 2023 as interest rates continue to rise, prices continue to decline. So earlier in the year, on average, you're going to see a higher price. Case in point, the 6-unit in Southgate sold for $294,000 per unit. That's a big number for Southgate. If you've owned in Southgate or in the local area for some time, you know if you start approaching $300,000 per unit in Southgate, that's a big number. And that property sold May of last year. This 5-unit in Huntington Park sold for $276,000, and that was in August of last year. Big price point for Huntington Park. And we see this, sometimes whether it's the condition of a property, quality, an investor, even though a seller may be asking above market pricing, there's just something about it. And there's an investor that says, you know what, I'm okay paying that above market price. And so we see these one-off sales. And then you have Bell Gardens, 5 units sold for $275,000. That was in October of last year. When it comes to rental rates, you can pause the video here, find the city or cities of your interest, and then go across, find your bedroom count, and that's going to give you your average. We pull this data from 3 sources: Zillow, Rentometer, CoStar. Bring together the averages, and that's what we give you in terms of the average per bedroom count. Are there units renting for less? Of course. Are there units renting for more? Of course. These are the averages, and this is a starting point. If you have a vacancy or contemplating some rental increases, this is a starting point of how to determine what those asking rents should be. The Western San Gabriel Valley, Rosemead, San Gabriel, Temple City. When we take a look at 2023, there were 7 sales. In 2022, there was 8 sales. So about the same. You're talking, there's a total stock here of buildings, 5 to 50 units, 1,926. So not very many buildings trade in this particular market or in these particular cities. Pride of ownership, we don't see a lot of movement of properties. Now, in 2023, we saw $32 million total dollars in sales volume versus $44,600,000 the year prior. So total sales volume was down 28% last year in this corridor. Now, when it comes to price per unit, last year, the average price per unit was $310,000, almost $311,000. The year prior, 2022, $316,697. So price per unit was down about 2%. So values held pretty well, even though we saw the market at large taking a much bigger dip than, say, 2% on average. The average cap rate for properties that sold last year, 4.95%. And here's a stark difference here because in 2022, it was 3%. So we jumped from 3% cap rates in 2022 to nearly 5% cap rates in 2023. A lot of that having to do with interest rates as interest rates have climbed. The average price per square foot in 2023 was $365 versus in 2022, $336 per foot. So interestingly enough, price per square foot went up over the course of last year in this corridor. Now, some sales to note. There was an 8-unit here that sold in Temple City, $468,000 per unit. That's a big price tag. And something to keep in mind is that a property that sold earlier in the year, 2023, was coming off that high of 2022 values. And as you get deeper into 2023 and as interest rates continue to rise, prices continue to slip. So on average, earlier you sold in 2023, you saw a higher price than if you would have sold later over the course of last year. In San Gabriel, there's this 5-unit that sold $350,000 per unit, and that sold in September of last year. And then in Rosemead, 10 units sells in May of last year, about $350,000 as well. Those are your highest sales in that market. When it comes to rental rates, you can pause the video here, find the city or cities of your interest, and then go across, find your bedroom count, and that's going to give you your average. The East San Gabriel Valley, Azusa, Balboa Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. When we take a look at total sales, how many buildings sold in 2023? 27. How many buildings sold the year prior, 2022? 52. That's a 48% reduction in the total number of buildings that sold. Well, how does that translate into sales volume? In 2023, we saw $71,870,000 worth of total real estate, multifamily real estate trade hands versus 2022, it was 185,000. So we saw a difference here of more than half when it comes to the total sales volume, the difference in total sales volume from year to year. Now, price per unit, interestingly enough, in this corridor went up. So while sales went down and sales volume went down, the price per unit went up. So we had 285,000, almost 286,000 average price per unit for the buildings that sold in 2023. And in 2022, that was 282,000. Now, there could be a couple anomalies, some sales here in the last year, maybe newer construction, these sort of things that kind of skewed the numbers a little bit, if you will. But again, we're including all sales that are between 5 to 50 units, and prices went up slightly in this corridor on a per unit basis last year. Cap rates though, cap rates went up. So in 2022, our average cap rate was 3.89. Last year, 4.53. So as interest rates in general, as interest rates have gone up, we've seen cap rates go up because you need to be able to close that gap between interest rate and cap rate. The average price per square foot, $338 this last year versus $366 the year prior. So we did see price per square foot come down. And in case you're curious, total stock, how many buildings are 5 to 50 units in these particular cities? Total, 1,871. So when I say that there was 27 sales over the course of last year, that is amongst 1,871 buildings that are in the area. Now, some sales to note. Highest sales over the course of last year. 5 units, El Monte, sells for $410,000. That's a big number in El Monte. I've been selling multifamily properties in El Monte for a number of years. You even approached $400,000. That's a big number. This went over $400,000, big number. That sold August of last year. I sold this 6-unit property in Covina for a client of mine. We sold this property here in August. That sold for $331,000, and that was a notable sale last year. And then a 5-unit sold in the city of Monrovia, $326,000. That was in August of last year. When it comes to rental rates, you can pause the video here, find the city or cities of your interest, and then go across, find your bedroom count, and that's going to give you your average. The 605 corridor, Bellflower, Downey, La Puente, Montebello, Norwalk, Paramount, Pico Rivera, Whittier. In the 605 corridor, there's a total stock of properties that are between 5 to 50 units, 3,225 properties. Why 5 to 50 units? Well, once you breach above 50 units, that becomes a different investor base. And 2 to 4 units, that's its own market of its own. Our clients and the properties that we help our clients sell and buy every day typically are between 5 to 50 units. So that's what we track. Total sales of that available stock in 2023, 44 sales versus 2022, there was 71 sales. So last year, total sales dropped off by about 38%. Sales volume. Now, sales volume in other words, if you tallied up the total of all the buildings that sold last year, you'd get 166,349,000. If you look at 2022, 269,336. So there was actually a 38% drop in total sales volume as well. Price per unit. The average price per unit for those properties that sold last year, 275,676 versus 2022, 291,849. So prices dipped in this corridor by about 5.5% over the course of last year. Interestingly enough, though, cap rate stayed about the same, 4.04 when you look at last year, 4.05 when you take a look at the year prior. What can that tell us? Well, in general, you raised the rental rates, but didn't do much in terms of the value because we saw price per unit come down, cap rates stay about the same. Price per square foot, on average, $346 last year. Year prior, $380. So price per square foot dipped as well. Some sales to notate in this corridor in terms of, because of the price per unit that they sold for. 7 units in Bellflower sold for $357,000. That was in November of last year. 14 units in Downey sold for $350,000. That was in January of last year. And then 20 units in Norwalk sold for $350,000 per unit. That was in January of last year. And typically, as we're looking at these various corridors, the earlier you sold in the year, the better you fared because you were coming off that high of 2022. The later you sold into 2023 because interest rates continue to rise, prices weren't as high in general. When it comes to rental rates, you can pause the video here, find the city or cities of your interest, and then go across, find your bedroom count, and that's going to give you your average. The Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and Upland. Now, this particular corridor, there's a total number of buildings between 5 to 50 units, 1,123. Why 5 to 50 units? Because that's the market that we track. That's what our investors own. Once you get above 50 units, that's its own asset class or its own investor base, I should say. And 2 to 4 unit properties has its own market of its own. 5 to 50 units is right within our wheelhouse, our sweet spot, if you will. And that's what we represent buyers and sellers on. Total sales, 21 sales in 2023 versus 38 sales in 2022. So total sales in this corridor were down last year by 45%. We look at the sales volume, about $60 million worth of property sold here in Inland Empire West in 2023. So in other words, if you tally up all the properties that sold last year, their sale prices, bring it together, about 60 million sold, versus in 2022, 104 million. So total sales volume was down last year by 42%. But interestingly enough, price per unit went up last year. So the average price per unit for the properties that sold last year was $256,000 versus $252,000 the year prior. So the price per unit actually went up. Cap rates rose last year. So we started out 4.07 on average in 2022 and rose to 4.77 over the course of 2023. No coincidence, because interest rates were rising. We needed to close that gap between interest rates and cap rates. So cap rates climbed and continue to climb. And then the average price per square foot, $321 in 2023 versus $302 in 2022. Some sales to note. There's a 6-unit property here that's sold in the city of Claremont, $366,000 per unit. Claremont, a very unique city, typically will fetch higher price per unit. That property sold in August of last year. And then 7 units on Howard sold for $364,000 per unit. This actually was my property that sold. We sold it on the open market. We'll put a link here. We did a video series on that fix and flip project, but that's still one of the highest price properties ever to sell in the city's history. And much of that has to do with the fact of the capital improvements that we put into the property. So again, you can take a look at that video series or any of the video series on our channel where I shared my own fix and flip projects. If you're looking for some ideas in terms of how to improve the value of your own properties. We sold that property in August because the writing was on the wall. We weren't going to etch out much more equity because the market was turning. And so it was time to sell. And then 48 units in Pomona on March sold for $302,000, a pretty big number for the city of Pomona. When it comes to rental rates, you can pause the video here, find the city or cities of your interest, and then go across, find your bedroom count, and that's going to give you your average. The Inland Empire East, Bloomington, Colton, Fontana, Rialto. Now, this corridor has a total stock of 287 properties that are between 5 to 50 units. So of that total stock, 7 properties sold in 2023 versus 14 properties in 2022. So sales were down 50% over the course of last year. When we take a look at sales volume, a little over $25 million in total sales volume sold in the Inland Empire East. In other words, if you tallied up all the sale prices of the buildings that sold last year, you'd equate to a little over $25 million versus $37,500,000 in 2022. So the total sales volume was down by about 32% over the course of last year. But interestingly enough, the average price per unit went up, and it went up pretty significantly. So the average price per unit last year, 2023, $246,000 per unit in this corridor. The year prior, $206,000. So definitely a jump in pricing, in value, I should say. Cap rate did rise as the other corridors. 2023, 4.42 on average versus 4.35. And our price per square foot did go down, $262 in 2023 versus $288 per square foot in 2022. Some notable sales. 12 units in Fontana sold for $254,000. And that's a big number. I mean, if you've been tracking the Empire East for some time, you know that, we went from $150,000 to $250,000 per unit in a fairly short order. So we definitely have seen an increase in values as more employers have come into the area, as rental rates have gone up, as housing has become more expensive, driving rental rates up in the area. It has carried the value of multifamily in an upward direction as well. Again, 12 units sold for $254,000. That was June of last year. When it comes to rental rates, you can pause the video here, find the city or cities of your interest, and then go across, find your bedroom count, and that's going to give you your average. So now, that's the data. That's the reality. That's where we began the 2024 market. So my question to you is, what is your strategy for 2024? If you follow our videos for some time, you know that we've interviewed Steven Spear, real estate attorney. He's also a very large investor himself. And he says, there's never a bad time for real estate. There's just bad ways to purchase real estate. And so piggybacking off that theme, the question here is, in 2024, do you look to buy, sell, hold, or refinance? If you look to purchase multifamily properties, you've seen the data, you see some areas of opportunity. Obviously, prices are down. That has much to do with the rise in interest rates. We just recorded a video with Gil Figueroa, commercial broker extraordinaire. We'll put a link here. I suggest you watch that video to understand what's going on with interest rates. But the bottom line is, the biggest culprit that brought values down was interest rates. Now, going beyond that, the adjustment we've seen in the market has been a long time coming. This adjustment began in 2019, whether you knew that or not. 2020, COVID and all that came with that, and the monetary policies stepped in the way of that market correction, took the market for another lift. But now we're seeing the correction that would, the writing was already on the wall in 2019. So you see some opportunities to pounce, to take advantage, to purchase areas that are poised for growth in terms of values and rental rates. And in case you're curious, our take on where are those areas, please contact our offices. We'd be glad to discuss all the areas that we covered today. We've sold buildings in all these when I say we have represented landlords in the purchase and sale of properties in all these various cities. I mean, I've been involved in more than 400 multifamily transactions now. And so we have our finger on the pulse of the market, and we can discuss some of that with you. But purchasing. Now, we're going to discuss a lot about purchasing in coming videos. But for now, we're going to put a link to our video where I discuss pillar 2, which is growth. It's the second pillar of the 3-pillar process that we share with our clients here. Head over, watch that video. And although that video was recorded 3 years ago, the principles remain the same. And so that's going to be some great food for thought there as you look to purchase and expand over the course of this year. Now, let's say you look to sell this year. Okay, but you're curious, okay, what do I do about the tax consequences, right? The capital gains tax. If I sell my property or properties, what do I do about the fact that now there's no more monthly cash flow? I will direct you over to our video where we discuss pillar 3, which is prepare for tomorrow. In that pillar, and we share with our clients exactly that. How do you prepare for your exit out of real estate? For many of you, this is it. You're ready to ride off into the sunset. You've done all the managing you want to do, but what are the options available to you? For many of you, you don't like the politics here in the state. You don't like rent control, the changes in rent control, and just this year alone, there's 14 new laws when it comes to multifamily ownership. None of them are in your favor, sadly to say. You can actually watch our videos that we recorded recently with Mike Brennan. He breaks those down for you. But the bottom line is maybe that's your reason to sell. But again, what do you do about the tax hit? What do you do next? Where do you take your money? I'll put a link here. You want to head over to our video on Pillar 3. Refinance, I mentioned that we just recorded a video with Gil Figueroa discussing interest rates and what have you. For many of you, you're sitting at a point where your loan right now is variable. And you probably went from 3.5% to say over 6%. You're not excited about that. Some of you are sitting at an interest rate between 7 and 9% because it's adjusted. Maybe you need to refinance now as opposed to let the rate float. And many of you are looking down the barrel of that shotgun as your loan this year. The fixed period will end and you're entering into a market where interest rates are much higher than when you first got that loan. Refinance, that takes a conversation in terms of what's available. And it also takes a discussion on, will you be able to refinance the current loan amount that you have because appraisals have changed, because interest rates have gone up. Again, contact our offices. We can put you in touch with a lender that can help you address that issue. What I want to speak more at length right now, though, or to those of you watching, is those of you that say, well, 2024, I'm going to hold. My question would be, what's your main concern? Because my guess would be there's some sort of concern that you have about transacting this year. Especially, you just seen the data and you're saying, well, Kris, I mean, look at it. 2023, in most corridors, there was a big slip in sales volume, price per unit, and so forth. Exactly. That's something you want to take advantage of. Remember, you are not going to have a situation where both interest rates and prices are low. They typically work inverse of each other. And so right now we do have a situation where interest rates are elevated, but if we're speaking historically, we're about around historic average. So I realize many of you had loans or were quoted loans at 3%, 3.5% a few years ago. That's gone. That's probably not coming back. And the only way it would come back would be with some sort of catastrophe. I don't think you want that. I don't want that. So if 5 to 6% is more of a historic average, maybe there's much to do about nothing right now when it comes to interest rates. I realize now, fourth quarter last year, we saw interest rates climb to about 7.25%. Yeah, right. That was a high interest rate. But now we've retracted. As a recording of this video, you have loans available today between 5.9 and about 6.25%. So that, again, is about average historically. So when I say what's your main concern, and if it comes to economics, I want you to consider this. I'm sure just prior or during or slightly after when you bought your multifamily property, there was some type of economic calamity. How can I be so certain? Because the market ebbs and flows. We go from recession to great times, back to another recession, right? Ebbs and flows. Market comes and goes. And so I'm sure that you've lived through these market cycles. And so what we need to focus on is what impacts multifamily properties, the values, the growth. Well, one factor let's take a look at is the income. The income is derived from demand. When we take a look at demand, we look at vacancy. Here's the bottom line. Housing is not going to get more affordable here in California. You are going to have a glutton of clients, tenants available should you get a vacancy. Now, right now, vacancies are taking a little bit longer to fill. But again, when we say a little bit longer, many of you have a standing list of people that are interested to rent your unit should you have a vacancy. And the minute you have a vacancy, you put a sign in the yard. I know that that's the best way to advertise, but you put a sign in the yard, you get many applications. I currently have a vacancy in one of my buildings. In 4 days, I had 160 inquiries through Zillow. And so I'm sure we'll get that rented in short order. So while yes, vacancies are up slightly, maybe it's taking a little bit longer to fill. Here's the bottom line. Our vacancy factor is next to nothing. Rental rates are very strong. The buildings are full. So when we look at the basics of the fundamentals of what makes multifamily a good investment, the fundamentals are there. What's the predictable trajectory? If we look at rental rates over the last 10, 20, 30, 40 years, they've gone up. If you take a look at multifamily values, what's the predictable trajectory the last 10, 20, 30, 40 years. They've gone up. And as you look at vacancy, historically, it's gone down. So the fundamentals are there. So the bigger question is, if you are convinced, even amidst some of the economic concerns that we have today, that you could improve your financial position, when we take a look at cash flow, appreciation, and tax savings, the three most important things when it comes to multifamily ownership, if you found that you could increase all three, do you keep an open mind to see your options? Have you had an analysis to even know what your options are? As opposed to saying, do I feel like selling or do I feel like fill in the blank? Well, that's subjective. And I'm not saying that doesn't go into the equation. But have you had the other side of that, the objective data to say, hey, here's my current rate of return on equity. Here's potentially what I could do with that equity in the market today. If you're not sure what your options are, you got to get that information. You have to get in touch with somebody that can walk you through and see exactly what are the options available to you. For those of you that are saying, Kris, no, I'm holding this year, not because I'm concerned about any economics. And I agree with you, Kris, that it's ebbs and flows. I'm okay with that. I'm holding because what I plan to do is to give my property to my children. That's kind of the end goal here. So that's why we're not looking at making any changes. My question for you, questions really, would be this. Number one, are you holding the properties and giving them to your kids primarily because you want them to hold and enjoy the cash flow so they can enjoy that income that you've enjoyed in your lifetime? Or is your primary concern the tax bite? You don't want to sell because you know that you're going to pay a significant amount in capital gains, and you'd rather the kids inherit the buildings, and hopefully when they do, step-up basis is still a thing. And so then obviously the tax situation will be much different for them. Those are two different scenarios. Let's take the latter in terms of giving it to your children. The question here is, and I mean this sincerely, have you had a conversation with your children or your heirs, whoever's going to get these buildings, in terms of what are their wishes? Now, if you have one heir, not so much a problem. There's only one decision that's going to go into, one decision that will go into consideration of when they inherit the buildings, do they keep them or do they sell? But if you have two or more heirs, I have to ask you, has there been a clear decision between the heirs what their wishes are? Are they on the same page? Because I cannot tell you how many times I have been pulled in once the heirs are already at each other's throat because they cannot agree and there was no plan when they inherited the properties. And so what happens is, your heirs inherit these properties. Oftentimes they have different economic means. Some want to sell, some want to hold. The ones that want to sell feel like, they're being held hostage because the other siblings or heirs don't want to sell. And those that want to hold don't understand why the ones that want to sell don't get it, through their thick head of why apartment ownership is so good and they should keep the properties like mom and dad, and don't they see all the good it did for the family? How do I know that's the argument? Because I can't tell you how many times I've been a part of it. I've had it so bad that I'm the go-between between the heirs. They won't even talk to each other, and I have to relay the message back and forth as we're going through a sales transaction. So first, I would say, have that discussion. What are their wishes with the properties? Is everybody on the same page? Now, if you're thinking, well, to address that, we have a main beneficiary, the main trustee here that's going to be the decision maker. We've chosen Billy. Billy, of his brothers and sisters, we've put him as point man on the paperwork. That's good, so Billy can make the decisions, but Billy has to make the decisions. And so I've seen where obviously there's other siblings may not be happy with Billy's decisions, and it creates some strife. And I imagine that's the last thing that you want, is that somehow your properties, your hard-earned equity that you've planned to be as a great gift to your children, and it is, but that would become what creates a rift between the relationship that tears the family apart. You may be thinking, oh, no way, no how would that happen in my family? And I hope that is the case. I can think of one client in particular. I asked the brother, I said, you and your siblings, was there always this rivalry between you guys? And he said, no. Actually, the complete opposite. We were best of friends until we inherited these properties. So again, that would be question number one. Are we all on the same page? Now, the second piece to that is, well, if your wishes are that your children be able to enjoy the cash flow from these properties, to give them a step up, because you understand that in order for them to create the same lifestyle that you've had for yourself, they're going to need more money in their lifetime, right? Given inflation and everything else. Many people can't even buy a home today, just given the cost of things. So, them inheriting the properties is your way to helping them through. Then would more cash flow be more ideal for them? In other words, there's many advantages for you to do a 1031 exchange to increase the size of your portfolio. Even if you're thinking to yourself, well, Kris, I have all the money that I need. Again, and that's the idea here. But your children, the heirs, especially if they had to start breaking up the cash flow 2, 3, 4, 5 ways or what have you, could you increase the income and the portfolio size now so that there's that much more benefit to them down the road? Or maybe said differently, if you hold, say, one property or two properties, but there's multiple heirs, there's no way to divide the property or properties evenly. Maybe you do a 1031 exchange. Let's say you own one building and you have 3 children. Well, maybe yourself, you do a 1031 exchange, the one building into 3 separate properties, so that each one gets their own property, and then they can decide for themselves. If they want to hold, great, they can hold. If they want to sell, they can sell. And they're not impacting their siblings. And then there's nothing to discuss. There's no vote to be taken. There's no main trustee to blame. Everyone makes a decision for themselves. I just give you that food for thought. If, though, you're not selling because of the tax bite, right? You're looking at a tax bill 40, 50%. Some of you maybe even higher by the time you have depreciation or recapture. Well, what are the strategies available to you to be able to mitigate taxes and still have monthly income? So you can do one of two things. I suppose there's more, but predominantly we see our clients do one of two things. One, when they sell, they carry back private seller financing. So in this scenario, a buyer puts, say, somewhere between 25 to 40% down payment, cash to you at the close of escrow. You as the seller would carry back the remaining portion in the form of a note. And then you would carry that note, say 3, 5, 7, 10 years, and charge them the prevailing interest rate at the time, and typically slightly above the prevailing interest rate because you're offering the private financing. And then that becomes your monthly cash flow. Now, does it do away with the taxes completely? No. Unfortunately, there's always taxes to pay. But when you carry back seller financing, you pay the taxes in 2 portions. When you receive the down payment, you would pay the capital gains tax due on that. When you receive the final balloon payment in 3, 5, 7, 10 years down the road, you would pay the capital gains taxes due on that amount. And in between, you've received this monthly income. Now, surprisingly, what we find is for many of our clients, when they sell in this manner and carry back financing, the income that they make on the note that they carry is actually more income or the same of what they were earning when they held the building. So for those that were, they were beyond the management, they didn't want to manage the property anymore. They wanted to be able to travel and get involved in their hobbies. They didn't want to be tied to the buildings anymore. We showed them this strategy, and lo and behold, my gosh, they can make the same income or more, no management. That could be the case for you. And here, when we're talking about taxes, again, it doesn't do away with them. But oftentimes when we calculate those payments over the course of time that you're holding the note, those payments to you actually pay your tax bill. So the buyer actually paid your capital gains tax bill for you. Of course, that takes an analysis. That's something that we could assist you with, but it's a consideration. Another consideration would be DST. DST investments have become very popular of late. I have 2 clients of my own right now where we sold their multifamily properties. They're doing 1031 exchanges into DSTs. I'm going to put a link here because I don't want this video to go too lengthy, so you can learn all about DSTs, but that's a great opportunity as well. If you're looking to pay no capital gains tax, because you pay no capital gains tax in that scenario, and you would have monthly cash flow. Now, for those of you watching who are saying, well, no, I don't have any concerns. That's not what's holding me back. And it's not necessarily my heirs that I'm concerned about as of yet. Because of your age, God willing, nothing should happen to you in the foreseeable future here. You're just happy with the situation. You're happy with either the property or the relationship with the tenants. And again, everything's fine. Everything's working great. My question for you would be this, and take an honest stock. If you were asked this question, although everything may seem ideal, what's one thing you would change if you were asked to make things more ideal? Now, for many of you may say, well, ideally, of course, we all like to make some more money. Or you know what? I wish I wasn't paying as much taxes every year as I am on the income because I have a lot of exposure. I don't have much depreciation to write off. I don't have a loan on the property because I own it free and clear. So I'm paying more taxes than I'd like to. Whatever it may be, whatever your answer to that question is. But if asked, how would you make your situation more ideal? Name one thing. What would that one thing be? Now, there's some of you, though, that maybe are saying, well, I just don't think that I could better my position. My tax basis is low. I don't owe any debt. I've done a good amount of improvements to the property. In other words, you just don't believe your position can be bettered. My question here would be, well, have you had an analysis? Have you really walked through this objectively to know what the financials say on the other side? If cash flow, appreciation, and tax savings is meaningful to you, and if you could see an increase in all three, do you keep an open mind to at least see your options, to see what the market may be able to offer you? That's what I would say there. Some of you are probably saying, I just don't want to go through the hassle. We're talking about a 1031 exchange, making changes. I'm adverse to change, just keep things as it is. That's its own issue. My question here would be, what's your experience with a 1031 exchange? Have you ever been through a 1031 exchange? Not what you've heard through the grapevine, but have you ever been involved in a 1031 exchange for yourself? Speaking here for our clients at the apartment dealer, and we coordinate many, many exchanges, 1031 exchanges in any given year. Our clients typically come out the other end owning more units with more income and more tax shelter. Now, that's kind of speaking or painting in broad strokes. Again, it takes an analysis to see what that increase would be for you. But nonetheless, my guess would be, depending on how much equity you would have, that you would see an increase. For many of you, the building that you're currently holding, when you bought it, truth be told, you yourself saw it as a stepping stone and that you would move on to bigger and better things. And then as time goes on, life happens, you wake up one day, it's 15, 20 years down the road, you still own the same property. But you started out with more grander goals and more lofty goals and what have you. Maybe it's time to revisit that. But again, can your position be improved? I'm not saying it's yes for everybody, but you don't know without an analysis. So is it time to have your annual equity analysis? That's what I'm offering to those of you that own here within the areas that we service. Of any of the different situations that I went through, if you're just curious, hey, what's my property worth relative to what's taking place here recently in the market? How much equity am I sitting on? If I were to take that equity and I had that equity at my disposal, what could that afford me in the market today if I was to do something different? Or if you're looking at exit strategies and saying, look, how do I get out from under this thing, paying the least amount of taxes possible? What can I do about keeping monthly cash flow in place? Strategy session, equity analysis. I'm happy to walk you through that. This is much of the work that we do here at the apartment dealer. Bottom line, as a landlord, and my wife and myself are landlords just like you, the name of the game is cash flow, appreciation, and tax savings, especially when you have the politicians breathing down your back and tenants getting free advice and free representation in the courthouses today. You best be making as much cash flow as you can. Properties should be appreciating if they're positioned correctly. And of course, you want to insulate yourself from paying more taxes than you have to. That comes to the question of what is your strategy in 2024? The apartment dealer, we're here to help. I hope you found today's video informative. Give the video a like, subscribe to our channel if you have not done so thus far. We have plenty of strategy and interviews coming up over the course of this year that's going to be very meaningful to the ownership of your multifamily properties, and more importantly, to the growth of your financial legacy. Kris German from the apartment dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.